Everyone thought that the Chinese EV companies would take over the EV industry. But guess what? Things are turning out very bad for them. The Chinese EV market is crashing, with growth nowhere near what it was just a year ago. And it's getting even worse than we thought. It's reached a point where it's not just about EVs anymore. The entire Chinese economy is crashing. But what has caused all this? Will the Chinese EV industry completely collapse? Let's find out with these 5 reasons why the EV companies are in panic mode. Number 5. Everyone is struggling. Large companies are having a tough time while smaller ones are barely surviving. If the big players are finding it hard, just think about how much harder it must be for the smaller ones. Due to the huge market crash, they're facing even bigger challenges. This struggle has been going on for years. In 2017, China had more than 500 electric vehicle makers registered. Now, that number has dropped to about 90. But even that figure is uncertain because experts say many of the remaining companies are inactive. Some only sell 500 vehicles every 3 months, while others can't even achieve that. Additionally, according to reports, only about 20 companies operate at 60% or more of their production capacity. It's not shocking when you realize that the top 10 electric vehicle sellers in China control 80% of the market. The remaining companies are essentially non-existent. With the persistent price competition, it's inevitable that many of them will end up declaring bankruptcy. Before we continue, if you're enjoying this video, do well to give us a thumbs up and hit that subscribe button to show your support. If you've done that, let's continue. Number 4. Slowdown in the economy. The slowdown in EVs is just one piece of a larger puzzle. After experiencing remarkable growth for several decades, the Chinese economy appears to have reached its peak, with little room for further expansion. The days of rapid growth are over, and now there are ongoing issues, such as an aging population and high unemployment rates. Boosting consumer spending has become a major challenge for the Chinese government, especially following the decline of the real estate sector. Real estate used to be the primary investment sector for many Chinese citizens, making its current struggles a significant concern. Additionally, the government has implemented measures to inject more money into its banking system and revitalize its struggling stock market. Research firms such as Capital Economics aren't very optimistic about the future, forecasting that China's economy will probably only grow by 4% in 2024. However, they do anticipate some positive effects from government stimulus spending, which should help boost economic growth. It's important to note that these changes won't happen suddenly. They'll take time to unfold. The process of consolidation will span across several years, during which EV companies will continue to face challenges. For instance, in the last quarter of 2023, companies like NIO reported a huge net loss of over $600 million, while Xpeng also suffered a massive loss of $500 million during the same period. Profitable outcomes are becoming increasingly rare, particularly since the onset of the price war. However, there are a few exceptions, such as Li Auto, which managed to record a profit of $385 million in the third quarter of the previous year. With clear indications of the Chinese economy slowing down, it's no surprise that the automotive market has already passed its peak. 2017 had the best sales, with 24 million new vehicles sold. Last year, around 21 million new cars were sold in China. Because of this, electric vehicle makers are finding it hard to succeed. They are likely to keep losing lots of money each year. Finding new investors is tougher than before for most companies. For example, big Chinese EV companies like NIO, Xpeng, and Li Auto have been losing a lot of their worth recently. Reports say their stocks dropped by 40 to 65% in the last few months. Number 3. Price war. As electric vehicles' growth slows and the car market reaches its peak, many companies are trying hard to stay in business. There are so many car makers now that even China's big market seems too full, especially for EVs. EVs make up about 1/3 of the world's second biggest population's market. Growth has slowed down a lot. Now it's only about 30% higher each year. So there are fewer and fewer new customers. That's why most car makers are having a price war. And it's not just small things like free charging or insurance. We're talking about massive discounts. This is the exhaustion war, where the biggest and most powerful companies believe that they could survive longer than the smaller ones and eventually take control of the market. The idea is to get out of this price war as a winner. But at the moment, everyone is losing tremendous amounts of money. Just take a look at the biggest players in the game. BYD cut prices by 100% or more, and other companies like Li Auto, XPeng, and GAC and SAIC are also giving big discounts. The price war has even pushed foreign companies to join in, as it's the only way to stay in business. For many years, Volkswagen Group has been a big player in China. Now they're also giving big discounts, especially on Audi cars, which are now 50% cheaper. BMW is doing the same thing, and Japanese companies like Toyota are also offering huge discounts on their cars. Number 2, BYD in decline. BYD is the biggest electric vehicle company in China, and likely the only one that consistently makes a profit. It's seen as Tesla's main competitor, both in technology and sales. However, it faces the same issue of too many companies in the local market. The challenge for BYD is that it hasn't made a strong mark in the global market. It sells some cars in Australia and Europe, but the sales aren't great yet. As a result, 95% of its production goes to the domestic market. Because of the slowdown, the biggest companies are feeling the most pain. In February, the company sold only about 50,000 vehicles, which is a big 37% decrease from the same month last year. Even with big discounts, sales aren't improving much, and there's expected to be a slight decrease for the whole year. Considering all these factors, it's not surprising that the stock market value fell by 23% in the past year. To boost confidence from investors and stabilize the stock price, the company's leader, Wang Shengfu, suggests buying back shares. BYD plans to spend $55.6 million on this. They hope this move will show that they believe in their company's future success. But even with these efforts, people in the stock market are still careful, watching closely to see how the company does. BYD's choice to buy back shares shows they want to improve their stock's performance. By buying back some shares, they aim to make each share more valuable, which should make shareholders happy in the long run. However, whether this works or not depends on a lot of things, like how people feel about the market, competition, and government rules for electric cars. While this plan might help BYD's stock price in the short term, how well they will do in the long run depends on how they handle changes in the market and if they meet their goals. Number 1, bankruptcy. The tough times have started. We've been warned about the challenges facing the Chinese EV industry for some time, and now it's here. Just look at the signs we've discussed. The market is slowing, stocks are dropping, and even the big companies are having a hard time. Need more evidence? Look at the recent bankruptcies happening right now. In just the past few months, 5 or more electric vehicle makers went bankrupt. And these weren't small companies. We're talking about once promising names like Evergrande, New Energy Auto, which is part of a huge Chinese conglomerate. Despite big investments, this EV maker couldn't become a big player in the market. It might be because they lacked the right technology, or maybe their business model wasn't good. Either way, the company went bankrupt. In addition, it's been revealed that the company lost $17 million on each vehicle it sold. Another example is WM, a startup that began with a strong start capital of $5.3 billion. However, even this large amount couldn't help them build a lasting business. Sadly, the company is almost non-existent today, despite actively seeking new investors. Speaking of investors, let's not forget to say a few words about SAIC. This is a Chinese state-owned company, and it also struggles a lot. Moreover, it's also on acquisition for new investors, and the fact that a state-owned company is now on the private market seems quite indicative in terms of the shape of the Chinese economy. Things are really bad. The CEO of Li Auto, a top electric vehicle company, summed up the situation well for the Chinese EV industry. He said companies must unite or they won't make it. With the crowded local market, he also emphasized the need for government action to prevent bankruptcies. If things don't change, many of the remaining companies will likely close down soon. The price war has made the whole Chinese car industry anxious. It's up to the government now to recognize the situation and take appropriate action. Alright, we've come to the end of this video. If you enjoyed it, don't forget to hit the like and subscribe buttons and let us know your thoughts in the comments section. We'll see you in our next video.